Emerging market assets have had a terrible year. MSCI's index of developing nation stocks is down 19% since its peak in late January. But now there are signs of a turnaround, and some of the world's biggest investors say the sell-off is overdone. Let's get the state of play from EM reporter Paul Wallace, who joins us from London. Paul, what are the signals then that EM assets are really back in favor with global investors?
Hi, Yusuf. While there's still no overriding consensus among investors that this rout is over, we are starting to see signs, especially in the FX and fixed income markets, that has in fact happened. The MSCI's index of emerging market currencies is set for a second straight week of gains, which is something that hasn't happened since January. Also, take Turkey and Argentina. Obviously, both of them saw massive sell-offs of their assets earlier this year, but this chart shows that there's been a significant rally in September. This chart shows the average Eurobond yields for Turkey and Argentina, Turkey in white and Argentina in blue. And this month, in both cases, their Eurobond yields have declined by more than 100 basis points to below 10%. And that's significant because you'd expect that the assets worst hit by the EM rout would be amongst the first to recover if this turnaround is for real.
Paul, several investors have called it to an end to the sell-off in recent months, only to be proven wrong. What makes you think it's going to be different this time?
The main difference this time is the dollar. Earlier in the year, when the dollar strengthened, emerging market assets were hammered. But in the last 3 months, the dollar has actually been very flat, and some of the world's biggest investors, JP Morgan Asset Management and BlackRock, among them, have said that the greenback has pretty much peaked. Now, if we take a look at this chart, it shows the performance of the dollar in white and the performance of emerging market currencies in blue. We've swapped the dollar index so that when the white line goes down, that actually shows the dollar strengthening rather than weakening. And as you can see, EM currencies and the dollar, well, the lines moved very much in sync for the first part of the year. And then from July, their performances diverged. Why? That was because EM currencies, since the start of July, have been underperforming, even though the dollar has been pretty much steady. Now, you'd expect some investors, at least, to take advantage of what's become an unnaturally large gap and for EM currencies to rally as they do so.
Paul, aren't there still plenty of dangers lurking for emerging markets? What about Donald Trump's trade war with China? I mean, that's front and center. And then you've got U.S. bond yields. Those are rising again, with 10-year rates climbing above 3% this week. That can't be good for emerging markets, surely.
Well, those are interesting questions, and the answers to them actually lend weight to this idea that the emerging market sell-off is over. When Donald Trump imposed more tariffs on $200 billion worth of Chinese imports this week, EM assets barely budged. In fact, China's main stock index, the Shanghai Composite Index, is actually set for its first weekly gain in about a month. So it seems that investors are less perturbed today about Trump upping the ante with China than they were a few months ago. And if we take a look at the US Treasury market, we see a similar theme there. Normally, when US Treasury yields rise, that is bad for emerging markets. But if we take a look at this chart, and this shows the correlation between US Treasuries and emerging market dollar bonds, and the correlation between the two has actually dropped to the lowest in more than 2 years. So as US Treasury yields are rising, EM Eurobond yields aren't rising as quickly. The spread between the two is compressing, and that is a sure sign that EM investors are regaining some of their bullishness.